Hi there everyone, Jeff Yu of Capitolate Finance here. I'll be discussing two options of how the interest on a bridging loan can be treated. 1. Withholding or retaining the interest. Withholding or having the interest retained is when the interest is deducted from the gross advance along with the fees at the start. It's a good option if your loan has a low loan to value because it keeps your total interest costs down and saves you from having to make the monthly interest payments. As an example, if you're purchasing a property for 100k and want a bridging loan of 50k with interest costs and fees totaling 10k, you could potentially apply to borrow 60k, which is 60% loan to value. This would work as this would be within a lender's 75% loan to value limit. And after deducting the interest and fees, you shall have a net loan of 50k, which is what you're looking to raise. 2. Rolling up the interest. The other option is to roll up the interest, which does mean you end up paying slightly more interest in total as the interest compounds during the term. However, it maximises the amount of money you can borrow at the start and helps with your cash flow, as you don't need to make any monthly interest payments as you pay everything at the end. If you want to roll up the interest, the lender will generally want the amount you owe at the end to fall within their loan to value limit. And here's the part people get confused about. Not only are you borrowing the amount you require for your purchase, but also the interest element too. So it is the entire facility that needs to fall within the lender's loan to value and not just the amount you receive on day one. This may mean that you may require a larger initial contribution, so it is important to ensure that your numbers work and add up. Now, these two options are good for the borrower as you're not required to make any monthly interest payments, which is ideal if you're undergoing a refurbishment project where the property will be empty and will not be generating any income during that period. What you have to be aware of though is that you shall be charged interest for the full term of your bridging loan. So if your term is for 12 months, the full 12 months interest shall be deducted from your loan. However, if you were to complete your project early, let's say 8 months, and you have been charged for the 12 months interest, those 4 months of interest that you have paid for that hasn't been used will not have to be repaid. But be aware as some lenders charge exit fees. There's no right or wrong way to treat the interest when given the choice. It will depend on your circumstances and what you want to achieve. So if you have any questions or need to discuss your bridging finance options, get in touch with us at Capitolate Finance.